Today we're going to be talking about retirement income planning. So Steve, as we work through the financial planning process with clients, with pre-retirees and retirees, what are some common questions and concerns that we hear from them?
For pre-retirees, the biggest question we get first is, what's my number? What do I need to get to by age 65 or whatever it is they retire? So they want to know their number. Next question they want to know is, can I do it earlier? So if you start at 65, what's 60 look like? Then they get into the questions of, where do I invest my money? How do I invest my money? When we move to the pre-retiree phase, different questions along the lines of, am I going to run out of money? I don't want to be a burden on my kids. So those are the focuses that for people at their retirement phase. It's interesting, regardless of what phase they're in, when we do financial planning for folks, there's three real phases, and there's the accumulation phase, there's the distribution phase, and there's the wealth transfer phase. I was teaching a class over at University of Richmond as a guest lecturer, and I asked this question to the students, and one of the students gave the best answer. It's the saving phase, it's the spending phase, and it's the giving phase. And every client, every person we talk to goes through all those phases. Why don't you take a moment and talk about the savings phase?
Sure. So with the saving phase, there's a few common principles that we see in financial planning. Really, it's save as much as you can over time in your working years. It's a systematic saving process. It's trying to build up as much wealth as you can, using the equities market as a great way of building wealth. We hear a lot of times stocks for the long run. If you have a longer time horizon, let's utilize the stock market to grow over time. Systematic saving helps buying in at different periods in the market, but that's really the general principle. Using your income during that time as a form of bonds and fixed income, where that's kind of your conservative portion of the portfolio, is your ability to work and earn an income. Some of the risks that we see, though, during that phase are really few from a standpoint of unprepared risks. You have, your general economic risks. Do I have the ability to get a job? Do I have the ability to earn an income? And then the unexpected health risks. What happens if I pass away early, when I have a family to take care of or debts to owe? Or if I get disabled, how to generate or how to deal with those risks over time. So that's usually the biggest issues and planning objectives that we see during that phase.
As we're going through that, we're helping clients form good habits of saving, the disciplines of not taking money, and really the principle of delaying gratification, saving money for today and not having to use it now. And there's so much noise about what you can do with money now, where you should invest now, and really just trying to get those people to form those good habits over the course of 20, 30, 40 years.
So as we move from the saver phase into the spending phase, as we enter retirement, how do those risks change? What does the new objectives for folks' financial planning look like as they get into that retirement or that spending phase?
It's interesting. Some things are almost 180 degrees different. I'll ask you a question because you're considerably younger than me. What's more important to you, a lump sum of money, a big chunk of money, or a guaranteed paycheck?
Well, for me, I would say I'll take a big chunk of money because I have another 30 plus years to work and earn that guaranteed paycheck over time. And that allows that big chunk of money to grow in the market and provide a pretty big nest egg in retirement.
And for somebody who's got a little gray on their hair,
it would be the complete opposite. It's you don't necessarily want or need the big chunk of money because you've worked so many years to accumulate that by systematically saving for retirement. So a lot of our clients, when they get to that retirement phase, they want to know, where is my guaranteed paycheck going to come from?
Yeah. So when we talk about the retirement phase, if you will, or the spending phase, there's really four goals that we're addressing with the clients, and there are the four L's. There's lifestyle. Lifestyle is, maintaining the same lifestyle. General rules of thumb is people want to live the same life they did the 5 years in retirement than they did the 5 years prior to retirement. So can they do that? And lifestyle is not linear because as we age, it's going to be more difficult to take the trips around the world when we're 80 as opposed to when we're 60. So lifestyle, liquidity, it's important to have access to capital for anything because you don't have that paycheck. And there can be a lot of different reasons, needs for liquidity. Longevity, and this is something we're going to talk about a little bit more, but the risk of living too long. What if you live a long time? That nest egg has got to last you for 30 years plus. And then finally, legacy. When people are in the accumulation phase of life or the saving phase, legacy is a tough thing to think about. But as we age and we start seeing our kids grow up and then we have kids, we start thinking about legacy, what we want to leave behind. And it's not just dollars, but it's habits. It's how the stories behind this wealth is how it's been accumulated.
Yeah, absolutely. So when we think about the spending phase, what are the biggest risks that folks in the spending phase have to address, and how might they differ from the risks that are associated with the saving phase?
So yeah, there's a couple. First of all, some things are exactly the opposite. When you're in a saving phase, time is your friend. The more time that you have, the better it is. Well, for us in retirement, for people in retirement, time can be your enemy. Longevity can be your enemy, and that is really can be it's a risk multiplier because then the longer you live, the longer you're exposed to inflation, healthcare needs, spending shocks. So longevity is a big risk. Sequence of return risk is another that I know you and I talk about is what if the day you retire, the market goes down 25%? Ibbotson and Morningstar did a study on the systematic withdrawal, and that a 4% withdrawal rate has a 92% chance of success over a 30-year period. So meaning that's an 8% chance of failure. But if the market goes down 25% in the first year, it now becomes a 22% chance of failure and a 78% chance of success. So there was nothing that you did. It's just the timing of when you got into your retirement mode and when you started taking money out. So sequence of return risk is a big thing. Volatility is your friend on the accumulation side. It's not your friend at in the retirement phase. Inflation, you've got to keep pace with inflation. Long-term care risk. This is, as part of planning, we always talk about planning for if you live too long or if you die too soon or if you get sick along the way. The biggest unknown risk in the retirement phase is a long-term care event. And when planning, you have to look at whether you can self-insure that risk or transfer it to an insurance company, but that's another conversation. One of the biggest risks, and I think this is the exact opposite when we talked about you in the saving phase, forming those good habits. When people accumulate those retirement dollars, it is very difficult sometimes for them to want to take the money out because they've been told their whole life not to take money out, to save, to be disciplined. And now we're telling them to take their money out. And psychologically, that is a hurdle for a lot of folks to get over. And so almost we're wearing a shrink hat more than we are the analytical side or the financial side. So I asked you that question in the beginning about the lump sum of money and the guaranteed paychecks and things along those lines. How do you guarantee or look to create that retirement income plan? How do you break it down?
Sure. So first, you need to address your spending needs in time segments or buckets. Typically, you want to have assets put aside for your short-term needs, your 1 to 5 years. You're going to have your midterm needs, 5 to 10 years. And then you're going to have your longer-term needs, 10 plus years. And that can be, you want to have different objectives and goals with each of those segments, and they're going to be invested differently. And so ultimately, when you look at that, how we're going to segment money, there's really 3 general strategies that we see in the financial planning space for retirement income planning. The first one is the systematic withdrawal strategy. This is a strategy that we typically see across the industry and across most clients' knowledge level, which is the 4% rule. Everybody typically has heard of some form of hey, you can draw 4% off of your assets each year and you won't run out of money. It's a very easy, simple to understand concept. It's typically, from an advisor perspective, very easy to execute. You have one big pot of money and we're going to invest it inside of that account on how to get you 4% per year. There are some real drawdowns to that, and would you like to speak on some of those?
Well, I think one of the risks we talked about before was that sequence of return risk, and the money in those portfolios. If the economy, if the markets go down the year you start withdrawing, that changes everything. You didn't do anything wrong, but the fact that you were just unlucky as to when you started drawing money has a big risk. The other thing is you have to factor in inflation, and depending on the performance of the portfolio, where you are, you might need to start taking significantly more than the 4%. And as you increase those percentages, your likelihood of long-term success becomes at risk.
Yeah, that 4% sometimes can become a 6 or 7%, and you're really drastically increasing the percent decline in portfolio.
But there's no doubt, and that's, it's fairly common, and we do it for our clients all the time. They understand, and you want to accumulate wealth, and it's a great way to continue to have your wealth grow, hopefully with an outpace inflation. Second approach is the bucketing approach that we talk about, and really, instead of having money in one big chunk, it's having specific purposes for each bucket of money. And it's really based on time horizon, like you were talking about, that 0 to 5 year, your 5 to 10, and your 10 and beyond. And we want to have specific objectives with each of those buckets to take care of those risks. For example, the longevity risk question. Well, you can segment some of your money to provide you an income that will last as long as you do, or as long as you and your spouse will be around. So there's a specific amount of money that you could allocate to solve that particular problem. Your next chunk of money is something that you want that's guaranteed, that for the next 5 years that money's coming in regardless of what the market does. And then the remainder of that money allows, or is invested more for long term, for those liquidity needs that we talked about. And then there's also, we can talk about a bucket that really you want some of your money to not do it exactly what the market does. Because if everything's going down, if the market's going down, everything's in the market, your accounts are going down. So you want to have some investments that don't work like the market does.
And so with that strategy, a couple of the risks that we typically see is it is a very complex strategy. It's not necessarily the easiest thing for clients to pick up and grasp from day one. Sometimes it takes a little bit longer. We are typically in a phase of life where we're trying to simplify life. We are at times making it a little bit more complex. And I think the biggest issue that we see, or the biggest planning hurdle that we have to get over, is when you deplete down the short-term bucket, the 0 to 5 year bucket, when is it the right time to replenish that bucket? Ultimately, a lot of those dollars are going to get replenished from the 5 to 10 year bucket. That is subject to some market risk, some general economic risk with interest rates and inflation. How do you determine when it's the proper time? That can put some general risks on things, and you may run the risk of having the short-term bucket be underfunded for a brief period of time, or it may be overfunded at certain times where now you're losing out on a little bit more market risk in your bigger, longer-term buckets. And the final build out of retirement income, or the final modeling that we typically see, is the flooring approach. We're seeing this quite a bit today with the way interest rates are. But basically, this is taking a certain percentage of your essential expenses and saying, I would like to have this covered with a guaranteed stream of income that I cannot outlive. Is not market dependent. The market can go up and down. It can be very volatile. You're still going to get the same paycheck every month. Social Security works very similar to this. So do pensions, and so do lifetime income annuities. real positives to this strategy. It eliminates a good portion of the longevity risk. Doesn't matter how long you live. You could live for a very long time in retirement. That paycheck is going to continue to come in the door every month that you're alive, and potentially every month that your spouse is alive. It definitely decreases market risks. There's a reduction in nervousness or worry about how the markets are doing each quarter if you know that at least your essential expenses are covered every month, no matter what. But there are some cons to those strategies. If you want to speak about those.
Right. First, it is the liquidity question. You can have, if you have a flooring approach and not enough liquidity, you can be at risk for those spending shocks. Some of these strategies keep pace with inflation, some of them don't. So the flexibility is a big thing. Also, the environment that you're in right now. If you're in a low interest rate environment, the promises you can get or the incomes that you can get might not be sufficient. So it's very interest rate dependent as well.
So while these methods have their advantages and disadvantages, a well-defined retirement income plan should incorporate facets of all three of these strategies. And in addition, a properly executed retirement income plan should consider a variety of complex planning decisions. Steve, can you expand upon some of those decisions that clients will have to make?
Sure. I think first, every situation's different. Access to income sources. Does the client have a pension? Do they have rental income in real estate? Real estate is a popular thing that people will, asset that people will use. And what is the income stream from something like that? Are they still involved in a business or getting income streams from there? Social Security is another one. It's claiming decisions. When do you take Social Security? Social Security is one of those vehicles that helps you protect against longevity risk. There are factors as to when you should take that, health being one of them. So that's another key factor. Liquidity events, and we talk about these things, not winning the lottery, but the selling of a business where there's a liquidity event, selling real estate or an inheritance, all those factors in to decisions that you make when you're building your retirement income plan. And then finally, the overlay of all this is doing it in a tax efficient manner. We talk all the time in our meetings about whenever money's in motion, there's a toll. The toll is taxes. And so as we're looking at all this, we want to make sure that we're making decisions in the most tax efficient way. A strategy that works great in the saving phase might not work as good in the spending or the giving phase. And finally, that giving phase, that third part, is ultimately, as clients go through this process, they really learn to believe that they're not going to be running out of money and that there's going to be something left behind. And it should go to, it's their money. It should go to the people who matter to them, the causes that matter to them. It can really go three places. It can go to their family, it can go to the charity, or it can go to the Uncle Sam. And I don't know of anybody who really chooses Uncle Sam first on that list. So it's important as we're having these conversations that we keep that in mind. In closing, people should have a financial plan, and that's their roadmap to get them to retirement. A financial plan in and of itself isn't sufficient in the retirement phase. You need a specific retirement income plan. And you'll find that the relationship that you have with an advisor during the accumulation phase is nowhere near as intense as it is in those 5 years before retirement and those first 5 years in retirement. So it's important to build that retirement income plan and continually come back to it.